Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my off-grid studio. We have a brave test taker. She's agreed to help us with some suitability. People are always asking, hey, Dean, do you have suitability stuff? And I have a suitability playlist that has 4 videos in it, but this is something we haven't put up on the channel that we're going to put up on the channel in terms of investment objectives and goals. Suitability association. What I mean by association is I always say, if you are struggling with suitability questions, which are judgment questions, the stronger you are on products, investment vehicles, the easier it will be to either do process of elimination, know what's clearly unsuitable given somebody's investment objectives, and get you closer to what is suitable. And that's kind of the game plan when associating the product. So here we go. We're going to talk about preservation of capital. So if I say to you as a baby broker, preservation of capital should be thinking money markets, government securities, agencies of those. What can you tell me about money market securities as it relates to the test as an investment vehicle?
Money market securities are good during short time horizons when the customer wants safety of principal. Say they were purchasing a home in 6 months and they needed something fairly liquid to be able to lock up their securities for a short period of time. They're backed by the full faith and credit of the government, which
Whoa,
gives them
whoa, 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 slow down, my friend. Started out very good. You said, Dean, if a customer is looking for preservation of capital and has a short time horizon, we would recommend money market securities or a money market fund would be an appropriate recommendation. But then you went a little off the rails a little bit because money market funds, money market securities are as high quality debt maturing in less than 12 months. The best money market security is a treasury bill. However, there are other things that do not have the full faith and credit of the United States
credit of the, yes, I
that
called that
are
mistake
also
after
money
I said
market
it.
instruments. Like
What was the question?
you said, I get kind of slowed you down a little bit, slowed because you were talking about full faith and credit of the United States government. And I then said, whoa, 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 whoa. Hold on. We've got other money market instruments that aren't T bills,
Correct.
that aren't T
Um,
notes and T bonds with less than a year, right?
Commercial paper
There
is
we go.
considered a T bill.
Commercial paper, which is issued at a discount, has a max maturity of
Commercial paper, 270 days.
right on, right on. What else besides commercial paper, T bills, T notes,
Um,
ones with less than a year?
bankers
Yeah,
acceptances
excellent.
sometimes.
Excellent. Bankers' acceptances, which are used to.
Um, bankers export foreign trade,
There you go.
right?
See, they're used to facilitate foreign trade. Excellent. Excellent. Okay,
Hmm.
we got one more. What's one more money market security? So far, we got bankers' acceptances, commercial paper,
Bankers, commercial paper,
T
T-bills.
bills, and
And I don't know why I'm blanking on this
that's all
final
right.
one. I'm
That's
trying to
okay.
think.
No worries. I'm asking you to peel it out of the stratosphere. Negotiable jumbo
Oh,
CD.
yes, negotiable jumbo CDs. Yes, those are also money market, and
Negotiable
those
jumbo.
are
Yep.
$100,000.
100,000 negotiable in secondary market. Excellent. Okay, so let's move on to our next one. We kind of hinted at government securities. T bills, preservation of capital, remember, is the heading. So preservation of capital, government securities would be T notes, T bills, T bonds, tips, you know, even I
Strip.
would even throw even the treasury receipts in there, even though those aren't really government securities. They're government securities, they're broker dealer stripped. Ginnie Mae is very testable. I know you're getting this right. What should you know about Ginnie Mae's besides they're in this
They
category because they have the full faith and credit of the United States?
credit, yes, and they pay interest and principal monthly,
Very testable.
and they're considered the safest of the
Well,
government
yeah,
agencies.
because they have that full faith and credit. And then remember, the other thing to know is they're fully taxable.
Yes, at the
Okay.
state and
So now
local.
my question to you is why are equities and direct participation programs Why are those in the category of being unsuitable on the right hand of the screen here?
For preservation of capital,
Right on.
DPPs are highly illiquid,
That's right.
um, and they're a little bit more of a risky investment. So if you're trying to preserve your capital, you're not going to do so by an illiquid investment.
Yep. And equities expose you to what kind of risk?
Equities expose you to inflation.
Well, they're a good hedge against
Um,
inflation. We're not talking about
They
inflation.
hedge against inflation. Sorry, I'm thinking of
Yeah,
bonds.
I'm asking about what
Um,
they're bad for. They expose you to systematic risk,
Systematic risk.
right?
Yes,
They
market
tend
risk.
to securities move together. All right. So somebody tells me they're interested in current income. We have lots of investment vehicles that can pay you interest income. We have government securities that pay you semi-annually, municipal securities that pay you semi-annually, and corporate bonds that pay you semi-annually. And so these would all be appropriate for somebody who says they need current income. We have GNMA. If it says monthly, that's a layup on the test, right? Customer says, I need monthly income. Woohoo. Then we say, all right. Equities and again, partnerships would not suit this. There are some equities that may be okay for this investment objective, may be suitable, and preferred stocks would certainly be suitable for this perhaps customer, right? Preferred stocks don't pay semi-annually, and common stocks don't pay semi-annually. If a stock does pay you, it would be quarterly. Now, sometimes if we're asking about debt securities and preferred stocks, we put that in a category called fixed income investment vehicles. And so, what is the risks of a fixed income investment vehicle?
That would be like interest rate and inflation risk
You
if
nailed
it's fixed.
nailed it. You nailed it. It's exactly right, right? If interest rates go up, these securities in your portfolio are going down. Now that's in the secondary market. So I mean that doesn't affect you if you're not going to be, transacting business. And you also have purchasing power risk. The risk that, I always joke about going to Nora's, which is my favorite Italian restaurant in Las Vegas. And, if I have a bond paying me 8%, $40 every quarter, that $80 will buy me a nice dinner at Nora's. But, if I go into Nora's 10 years from today, that $80 may not buy me a nice Italian meal with a couple of cocktails, right? So, not all common stocks pay dividends. Not all common stocks do. We associate dividends with mature, stable businesses. And utilities are certainly mature, stable businesses as it relates to the test. What else can you tell me about a utility stock besides that it's a reliable dividend paying kind of a stock?
Wouldn't that be suitable for like period of like deflation
Well,
or if the
you're right on. You're right on. Utility stocks are considered defensive because their products and services are resilient to the business cycle. Peter Lynch is a legendary portfolio manager at Fidelity, and I recommend reading everything he's ever written about investments. But one of his tenets is you should only buy stocks that any idiot could run companies because sooner or later some idiot will be. And he says he likes the simplicity of a utility company. People don't pay their bill, you shut off their power, right? Now, these utility companies have what we call a higher dividend payout ratio. Of their earnings, they pay out a larger portion as a distribution to their shareholders, a dividend. That's called the dividend payout ratio. Counterintuitive, but utility companies borrow lots of money. In terms of their capitalization, which is equity and debt, a large chunk of this debt, so they're interest rate sensitive. Now, any type of investment vehicle we have, you can find that same investment vehicle in mutual funds. And so, what would be the advantage of buying a mutual fund that owns government securities, or a mutual fund that owns municipal securities, or a mutual fund that owns corporate debt securities, or preferred stock or dividend paying stocks.
Wouldn't that just be more tax efficient and give you that broader diversification?
There you go. You nailed it. The advantage of owning these debt securities, preferred stocks, or dividend paying common stocks in the context of a mutual fund is you get professional management and you get diversification. And then it's just easier owning a mutual fund than it is to actually own the individual securities. All right, so capital growth, moving on. My customer says he's interested in growth. The three major things that people are interested in, the holy trinity, if you will, is growth, income, or safety of principal. And so if my customer says growth is what they're interested in, now the way I say this is there's only two ways to make money: the income stream and or price appreciation. And so if somebody tells me they're interested in capital growth in their portfolio, their investments, we would not recommend a debt security. Yeah, I mean, could you get a little growth perhaps as the Fed lowers interest rates? But, the way I think of debt securities and why they're unsuitable here is because people who are buying bonds are, for the most part, already where they're at financially. They're not trying to get ahead, they're just trying not to get behind. That is not true of somebody who's buying common stock. So that would be a great recommendation for somebody who wants capital growth. What else would make that a good recommendation?
It'd be a good recommendation for someone that's trying to combat inflation.
There you go. You nailed it, right? So if somebody's trying to beat inflation, the two major impediments to investment success are taxation and inflation. If you can beat taxation and inflation, you're getting ahead. So you nailed it, right? Common stock. Now, be careful. Sometimes people confuse tips with common stock. And, the tip keeps pace. It doesn't beat inflation. I mean, if you get
Right.
out of your time machine 10 years from today with tips, you'd have the same purchasing power. That's a little different than if you get out of your time machine 10 years from today and you had common stocks. You would hope that you would actually have additional purchasing power. I mean, there's no sense in delaying gratification if you don't have more purchasing power. All right.
Right.
Well, as I just said, the two major impediments to investment success are taxation and inflation. So you say, hey, Dean, I'm interested in tax advantaged investments or tax favored investments. We wouldn't recommend corporate securities because corporate securities are taxable. They're taxable at the federal level, they're taxable at the state level. We might still recommend them in the context of being in a wrapper of some sort. And so, what can you tell me about IRAs?
Tax. They're qualified investments, right?
Well, I'm not going to call you out on saying qualified because for test
Because
take,
there's certain
yeah,
ones that
here's what I
are
mean by why I'm not going to call you out on that. Qualified would mean something like
pre-tax.
IRS. That's why I'm saying that's okay because I don't think that would cause you any misses on your test. What
Right.
you're going to do is reduce your adjusted gross income, assuming you're qualified. You may or not be able to do this, but you might be able to fund an IRA and take your gross income you're paying taxes on down. And
Right.
what should you fund the IRA with? You should fund the IRA with cash, and then you should use it to buy securities. And so that money in your IRA is going to grow tax deferred.
And
When could you choose to draw down that tax deferral? So it's tax favored. What age could you choose to draw down?
73 and a half, right?
Now, be careful what I asked. I asked, when could you choose?
Oh, 59 and a half.
There you go. When must.
Sorry.
There you
I
go.
couldn't really hear you over the
Well,
question.
that's okay. That's all right. RMD is right 73, right? So RMD is very testable. Is there a type of IRA that has no RMD?
The Roth
Right
IRA has
on.
no
That's
RMD.
right. That's right on. Tax favored annuities. Annuities are tax favored. The same
Tax,
reason you have
yes,
tax
tax deferred.
deferred, right? So both of those are tax favored investments. So if the customer says, Dean, I'm interested in tax favored investments, then we might, these are arrows in our quivers, so to speak. Um, it's important the customer understand whether it's an IRA or an annuity that they're going to be paying taxes at ordinary income tax rates when they're taking distributions. So, when they get to 59.5, they're going to have perhaps a, tax implication there.
Right.
Muni bonds pay tax-free interest, so that would be great for somebody in a high tax bracket, right? So now, by the way, be careful if it's a mutual fund that has muni bonds in it, the tax-free interest is distributed to you as a dividend. So, again, for all these, we might actually recommend the mutual fund version of it versus the individual muni bonds, right?
Right.
Corporate diversification, we talked about systematic risk. And diversification, is an important concept. But in diversification is where you own more than one security or you own a mutual fund. And, the fewer the securities you have, the more exposed you're going to be to non-systematic risk. Non-systematic risk, right?
Hmm.
Systematic risk, you told me earlier correctly, is the tendency of securities prices to move together. You still have that in a mutual fund. Non-systematic risk is associated with a lack of diversification and what we call selection risk, right? So,
Which is like business, legislative.
right on, right on, right. And those are risks that can be diversified away or mitigated through diversification, right on, right.
Right. And then with systematic, it's market purchasing power and interest rate risk are all systematic risks that cannot be diversified away.
There you go. There you go. Perfect, perfect, perfect. We talked about pacing with inflation. And we said if somebody's worried about purchasing power risk, inflation risk, the risk that in the future, the same amount of dollars are not going to buy you the same level of products and services, common stock or common stock mutual fund.
Or
Uh,
annuities.
yeah, I hate this one with a passion. So be careful here. And what I hate about this with a passion is as compared to a fixed annuity. You know,
Well,
I
a
think variable
fixed
annuities.
annuity is subject to
Yeah, yeah.
inflation because it's fixed.
That's right. The variable annuity has that separate account. Now, don't tell any of my insurance friends, but I just think, as it relates to investments, variable annuities really kind of suck with the other things available to us. So there are heightened suitability questions about that variable annuity. Now, first, we shouldn't be funding a variable annuity until we've taken advantage of every other thing
Or
available to us, right? Like IRAs, for example, or 401k or whatever, we have available to us. All right. We talked about liquidity. You nailed it. There's an exact question about the buying a house. The question goes something like, your client is being relocated, has sold their house in New York or California, and they're being relocated to Texas or Florida and they're going to be renting until they just have a neighborhood they like, and then they're going to buy a house, and so they're going to need that money they got from the arbitrage of the house in New York and the house in California versus the house that they're going to buy in Florida or Texas. What should they do with the money? And you nailed it, money market.
is
Now,
there ever a situation where a government agency fund like the Ginnie Mae, Fannie Mae is going to be more suitable than a money market fund with someone with a short term
no, 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 because the
time
Ginnie Mae,
horizon?
remember, the Ginnie Mae portfolio has interest rate risk because the people in the mortgages can refinance.
Right. They could
So
refinance.
I
Yeah.
can't imagine where that would be the correct answer. Where I thought you were going, and this could be, we do have money market mutual funds for political subdivisions, cities and counties and school districts called local government investment pools. And they too would be buying these money market securities. So I thought that was where you're heading, but no, I can't think of where we would be buying that. Now, listed securities are very marketable, right?
Right.
You can turn your money back, your stock into money in T plus one. I thought it was interesting. I was watching an interview with Mark Cuban about selling the controlling interest in the Dallas Mavericks, and they were asking him what made him decide to sell his controlling interest, and he said, "Well, you should, when I first, bought the Dallas Mavericks, I was one of the more sophisticated owners in the league, and I had resources and I could buy like a draft pick for 10 million. And then he says all of a sudden Steve Ballmer shows up and sells $2 billion worth of Microsoft stock. and buys the Clippers and then sells another $5 billion worth of Microsoft stock to build a new arena. And, I thought, man, the nature of this business is changing. And there's all kinds of these folks that have a liquid net worth, like Ballmer, $180 billion, right? And I saw him being interviewed, and he said he decided that he was going to come in with a knockout bid, just sell some Microsoft stock to knock Oprah off there. Oprah was bidding for the Clippers, and David Geffen. These are all billionaire people, but they just don't have a liquid net worth like Ballmer does. Not a coincidence. Cuban sold to the Adelson family. The Adelson family again did the same thing as Ballmer. They just sold X number of shares of the Venetian to cash out Mark Cuban. So a Nasdaq New York Stock Exchange security can be turned into money very quickly. Now, I'm going to talk about something I don't usually talk about, and I'm going to talk about it now in this video. Thank you for sharing and allowing people to take a free ride with you. There's a difference between marketability and liquidity. So I want to bring this up as it relates to listed securities. Liquidity is how quick can you turn an investment into cash. Marketability is how quick can you turn it into cash at close to the price you paid, right? So money market funds are both liquid and marketable. They're liquid and marketable because the NAV is held at $1. Or same thing with local government investment pools. Now that Microsoft stock could go up or down, right? So on any given day, that could be a difference, right? Mutual funds. How do you access liquidity in a mutual fund? You know how you would access liquidity in a mutual fund?
Well, the mutual fund is an open-end fund, so you would do it at the NAV.
There you go. So if you send in a redemption request to your mutual fund, how long before you would expect to have that cash?
7 days.
Good job. Excellent. 7 days, right? So anytime you want, you put in the redemption request. How much money are you going to get when you put in the redemption request?
The NAV at the end of the business day.
Yeah, from when you
Or
receive.
forward, yeah.
There you go. You nailed it. That's that idea of forward pricing.
Yeah.
Thinly traded securities don't have much liquidity because again, there's going to be a bigger spread. The thing here in terms of unsuitability I like to use is automobiles, right? I have a Hyundai Santa Fe. Over the course of my career, I've had many different cars, some of them pretty exotic. And those cars aren't very marketable or liquid, right? Turning a, Audi R8 back into money, it's going to be a bigger difference between the bid and the ask. Same thing with securities, right? If I am a Lamborghini dealer, I probably don't buy or sell many Lamborghinis, but when I do, the spread's huge. If I sell Hondas or, Kias or, things like that, my spread's going to be a little smaller. Now, be careful. Not every security that is thinly traded is a penny stock, right? What we're saying here is thinly traded securities would be an inappropriate, unsuitable recommendation for somebody who needs liquidity. But there are penny stocks, and typically penny stocks are thinly traded. There's a huge difference between the bid and the ask. Could be a nickel on the bid and 25 cents on the ask. What is the definition of a penny stock? One of the risks in penny stocks is this idea of they're thinly traded and have bigger spreads. But what is that definition?
It's an over-the-counter, under $5 stock. It's not traded on any national exchange.
There you go. So
Um,
non-NASDAQ OTC stock under 5. You're absolutely correct. Why are direct participation programs guaranteed test question? Why are direct participation programs an unsuitable recommendation for somebody who needs liquidity?
they're, I know that they're on illiquid, and they're illiquid because they're private
Yeah, they're
placements,
liquid
correct?
because you can't get in or
And
out
out,
without the permission of the general partner.
and they're very risky
There you go.
investments,
There
and
you
you
go.
have to sign a
Oh, I like it.
document.
Yeah, suitability, saying you understand what you're doing, right? So You
Right.
know, later on when you say you didn't understand that, we say, you said you did. Your customers go backwards a lot. So speculation, derivative products. I wouldn't worry about futures as it relates to your Series 7 because we don't offer futures with our Series 7. I joke with your Series 7 registration, you're going to be a master of disaster, a jack of all trades, master of none. You can pretty much do anything except futures. But what are some of the speculative option strategies available to somebody who wants to speculate?
Wouldn't that be all the hedging
Well, it'll be the opposite of
strategies?
the hedging, the opposite of the hedging, right?
Speculative.
Speculation is the option of hedging. So it's everything.
Oh, okay.
But,
I don't
and
know why I
that's all
misunderstood
right.
you
That's
then.
all right. That's like no big deal, right?
So
So
opposite of hedging.
yeah, so this would be where you're buying or selling volatility on a stock price. That's it, period. You're not buying the stock, you're not going long the stock, you're not going short the stock. You're simply using options to either buy or sell the volatility. You're betting on the volatility of a stock. And we have some strategies for making bets. You're either buying the volatility or selling it. What would be some bets you could be? I'm saying this a little differently, by the way, in this video than I usually express it. Yeah, because it's a new video, and we're always trying out new things. And thanks for being a beta for trying out new things. So I'm referring to this instead of being bullish or bearish. I'm referring to this as either buying or selling volatility. So if you're buying upward volatility, you're buying upward volatility. That means you're making a bullish bet on the stock price. It
Right.
is very difficult to be a speculator and buy an option and make money. And here's why. You would have to be right about three things: direction. Here I'm telling you we're buying upward volatility. You'd have to be right about how far, and you got to be right about timing. So, what are some things where we could speculate by buying upward volatility?
Buying upward volatility, I would think of buying a straddle.
Well, that would be buying
Oh,
non-direct.
volatility. Okay. I think I'm just misunderstanding by the way
Well,
that the
well, I'm
questions are
saying it.
being
I'm saying it in a
framed.
rather. I'm saying it purposely in a a harder way, right? So, if we're buying upward volatility, one thing we could do
A
is
long call, right?
that's long call. So, we're speculating on the price going up, right? So, you say, "Hey, Dean, I think this stock is going up," and I say, "Well, you want to buy the stock or you want to make a bet, buy a lottery ticket on the stock?"
When you say volatility with
Yes.
options, my mind just goes into a straddle. That's
Well,
just where
oh,
it
well,
goes.
that's okay for test purposes. It certainly is. We can buy a call. So we would be buying
Right.
upward volatility. We would be bullish.
Bullish, correct.
Right? What else could we do?
You could sell a put.
We could sell a put right on. And if we sell the put, we're selling the upward volatility, right? We want it to go up so we can keep the money right on. So, one thing you could add to this as a speculator is I might say, hey, uh, we could lower our out-of-pocket cost on the long call by doing a debit call spread. We would need less volatility, less upward volatility, cover our out-of-pocket cost if we sold the higher strike to help us pay for the lower strike. We'd still be buying a call, basically, right? We're buying the spread. Now, if you
Right.
sell the put, as you're absolutely right, that's a bullish transaction. And here, what you're doing is you're selling the volatility. Upward volatility or selling the downward volatility, however you want to think about it, but you're bullish. You're absolutely right. I say now the problem with that put is if you're wrong, somebody's going to stick it to you. If you're wrong and that stock doesn't go up, you're going to have some problems. So maybe you want to consider taking some of your money and buying a lower strike put just in case, just in case. So those are, and you kind of are on the right track once again, because you said, Dean, And what happened? You're saying this differently than you usually say these things. I say, yes, we're trying in this video to stretch your mind, but doesn't come back to the same spot. That may not happen, that's what we're trying to do. So we started by saying there are two players that come to the options market, hedgers. And I said, no, 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 this is speculation. And people who are speculating, right? And so we have bullish transactions, we have bearish transactions. And
The
again, the way I've
bearish.
said this differently, is
Mhm.
I've said when I buy a put, I'm buying downward volatility. When you're buying options, volatility is your friend. And when you're selling volatility, it's your enemy, right?
Right.
So that's what we're basically doing. And so when we buy a put, we are buying downward volatility. So we're speculating on the price going down. Now, if you've been with me, and I know you have, you've been with me quite a while. And something that I always, always say is be a smart bear. Do not be a dumb bear. There's all kind of foolish things you could do as a bear. And as Dean says, don't be a dumb bear. Buying a put is a much a kinder, gentler way to be bearish, right? Because if you're wrong, you just lose your what?
Your premium.
Be a smart bear. I tell the story a lot. Maybe, I apologize. We just crossed a million hours of watch time. Can you believe that? I know you've spent some hours with me and I appreciate it. But oh my goodness, I never in my wildest dreams ever thought
A
people
million hours.
watching my YouTube channel. Anyways, I tell a story and I'm going to tell it again. So, I went into this chat room and I was bearish on the stock and I hadn't done anything yet as a bear. And so I said, are there any bears in the woods? And, this lady pops up. She goes, I'm a bear. And I said, well, listen, you and I have to convince these people they're wrong. These people are all kinds of raging bulls in here. And so we need to convince them they're wrong. And she says, well, what have you done? I said, well, I haven't done anything yet. And I haven't decided what I'm going to do. And she said, well, I sold 10 of the 40 calls naked. I said, well, of all the bearish things I can do, I can assure you that's not what I'm going to do. And I got 4 points. I said, that's $4,000. So if the stock is 40, or, if the stock is 40 or higher, the calls will, excuse me, 40 or lower, the calls will expire and you make $4,000. I just think that's a stupid thing. I said, what I might recommend to you is that you take some of your premium and buy a lower strike call just in case. Anyways, I told her what I did. I said, I bought the puts. I bought the 40 puts for 10 of them. That's $4,000. If Dean is wrong, I'm just going to lose $4,000. So this is a better way to go. Now I could lower my out-of-pocket cost by doing a debit put spread. In this case, why? I mean, 4 points. There's no sense in selling a 30 put for a point there. All right. So those are ones. Now you brought up a speculative strategy, and you brought up a straddle, and you were correct on the straddle. A straddle is indeed a speculative strategy. And we have two versions of that, right? Again, you can
Yes.
buy the volatility. Now you're buying non-directional volatility. You're not quite sure whether you're going to do this or you're going to do this. So you do them both. And that would be a long straddle. Right? So we have long straddles and we have short.
Um,
Right? So those would
yes.
be two of our speculative. By the way, speculating strategies, right? So long and short are usually a higher level of approval at the broker dealer than is, hedging, right? So we
Right.
talk about hedging because this customer isn't interested in hedging. They're interested in speculation. I don't like that we put high yield bonds here into the speculative category, but yeah, you're speculating that the bonds aren't going to default, right? So we don't call them junk on the death because that's prejudicial. We call them high yield bonds. And the reason they are high yield is because they have a lower credit quality. Test question. What is the credit rating of S&P below which a bond is jumped?
What is the credit rating?
Yeah. What is the credit rating that would make a bond less than investment grade?
Oh, that's going to be B AA.
Well, if you're,
Or BA.
I asked you Standard and Poor's. So
Oh,
Standard and Poor's, triple B is investment grade.
triple yes, and then underneath that.
Yeah.
Sorry, I was
No,
thinking of
no,
Moody's. I don't know
no,
why
no
my
worries.
brain's going everywhere today.
No worries. No worries whatsoever. Anyways, here recently, Boeing sold $30 billion worth of securities, a little under 30 billion, to shore up their balance sheet. And one of the reasons they wanted to shore up their balance sheet is not only did they need the additional liquidity, but Standard & Poor's said they were strongly considering downgrading Boeing to double B if they didn't do something to fix the holes in their balance sheet. So boom, sector funds again are speculation. I have not. Now listen, I'm not a speculator, but I'd be surprised. I'm sure if you're watching this video is being made in the end of 2024. I don't know if we've rolled out yet a sector fund for AI. You know, we're betting on a particular sector of the economy, whether it would be, tech or whatever it happens to be. If this is a mutual fund, we would expect this sector fund to have a higher level of volatility. A sector fund would be like my Mexico fund. It's diversified, but only within Mexico.
Within the certain sector.
Right on. Okay, so another thing that somebody might be interested in is leverage.
Oh, my
Ooh,
favorite.
yeah, making a little money, do a lot. Making a little money, do a lot. There's a couple ways you can get some leverage. One way you can get leverage is to open a margin account and you'd be making money twice as fast. We should warn this customer they're going to be making money twice as fast, but they're also going to be losing money twice as fast. So to open a margin account, there's going to be additional documentation required.
Yep.
And what is the additional documentation required to open up a margin account?
The hypothecation agreement.
You are correct. Very testable. The hypothecation agreement, which is mandatory. That's where you say you understand you're pledging your securities as collateral for the loan, and therefore your securities are going to be in street name, the name of the broker dealer. In a cash
The
account, we still want you to put your securities in the street name, the name of our brokerage firm, because backstage makes it much easier for us. But a
is
margin account,
the oh, sorry, go ahead.
yep, you're correct. So what's next?
Isn't that the credit agreement?
Right on the credit agreement. You are once again correct. It's mandatory. That tells the customer they're borrowing money and they're paying interest based on broker call. Very important. A margin account, that loan, either to buy securities or you can borrow money to do other things, uh, can be a very competitive loan. So that too is mandatory. So we've got the credit agreement, we got the hypothecation agreement. What else?
The loan consent agreement, but that is not mandatory. That is
Woo!
the agreement where you are letting your broker dealer pledge securities out, um, and you don't know
Yeah, the loan
pretty
consent
much
form,
what
you're
they're gonna.
absolutely correct, is optional. I'll just clean it up a little bit. This is where you give us permission to lend your securities to other customers who wish to
Yes,
go short. And you say, hey, Dean, it's not in my best interest to let people use my security. They go, I know. That's why this part of the document is optional. You do
because you're
not
at
get
risk, right?
that's
For the securities not being returned to you.
well, yeah, I mean, that's true. I haven't heard of it where we don't get our securities back. I mean, we have
But
people, the brokerage firm, who are charged of fiscal responsibility and make sure that doesn't happen. But it's just not in your best interest to help the bears if you're a bull, right? I doubt that Larry Ellison would let Morgan Stanley lend out his securities, right? He's a Morgan Stanley customer. Uh, Cash accounts have no leverage, but again, that means less risk, right? You can't go bankrupt if you don't owe anybody any money, right? So that's the cash account is out for leverage. Option account provides tremendous leverage. We were talking about buying a call contract, and if I buy an Apple call contract at 2:30, And let's say I pay 10, my break even's 240, Apple goes to 260, I've tripled my money. Now on both margin and options, the same supercharged speed we're making money with is the same supercharged speed we lose money. Now you nailed the documentation required to open a margin account. There is, again, very testable, going to be additional documentation and processes to open an option account. So how do
That
we open an option account?
that's the option disclosure document, and it has to
Right
be
on.
returned within 15 days of um I can't remember if it's account approval of the or the first trade, but I know you have like a
Okay, well, we have
Dado
a great,
15.
there you go. And if you were on your actual exam and we said we're asking you to pull things out of the stratosphere, and on your actual exam, they would have, an answer set for you. And I think based on that answer set, you would be able to get this correct. So I give you the disclosure document. That's the D. I go back to a registered option principal. I get your account approved. That's the A. We do our first trade. I say, hey, I got your option account approved. You go, great, let's do our first trade. I say, okay, now just by way of reminder, within 15 days, we need back the option agreement that you read and understood, that disclosure document. What happens if the 15th day comes and goes and we don't have back from you that option agreement?
What happens?
Yep, you're only going to be allowed
To
offset,
do closing, yes,
the
transactions.
offsetting transactions, indeed.
Right.
Setting transactions. I say, listen, for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I'm going to be in determining suitability. You say, well, it's none of your damn business. I say, well, actually, it is. We have a know your customer rule, right?
Yes.
So, current or future financial needs. Where is your financial destination? I always think of it as I'm taking my client on a financial journey together. I
Hmm.
told you, who would have ever thunk it? But hard to believe I actually have friends before I started a YouTube channel. But, now some of my friends see me on there. One of my friends said, Dean, I see you are on the, and I have, some investment things. And, I'm trying to be nice if I say, well, no, that's not what I do any longer. I'm not trying to sell investments on YouTube. That's not the goal. But anyways, here we've talked about it. It seems like you did a pretty good job on this current financial needs. If the current financial need is short term, then we recommend money market, liquid securities, shorter term debt. We wouldn't recommend a longer term debt because remember, longer term debt test point is more volatile,
Yes.
long and low, right?
And
Yeah, yeah, go ahead.
I think it's important to recognize in this specific section that you need to pretty much do that equation like 100 minus the customer's age to
That's right.
figure out what level of
There we go. So let's see. Let's say down here, see you're front running. I like that. You're a front runner trading ahead a little bit. But as you see here, we are going to ask you your age. Now, I know you're a young lady. So what is your age?
27.
So 100 minus 27 means, again, it's a cocktail party to this extent trick. What I mean by that is we wouldn't have somebody come into our office and go, hey, 27, 100 minus 27, we're done. But on the test, right, Series 7 Fantasyland, this works because that gets me to, okay, I'm thinking
Like
70%.
73.
Or yeah, I'm
Yes.
62. So 100 minus 62, even though Dean doesn't believe this, I would probably have a problem with the compliance officer because I believe in being fully equitized. So, but
Right.
assuming I'm not a high volatile person, you'd say, well, Dean, about 38% would be where you should have your equity allocation. So indeed, I think that's a neat trick. And thanks for sharing that with others because that is something that can get you, if not the appropriate answer, sometimes the right answer, but at least get you to a 50-50. And when it comes to suitability, man, 50-50s are something we need to embrace, right? I mean, that's just
Right.
got to do. So your current and future financial needs, again, now we're tying the product itself to the
Mm-hmm.
particular customer. So that's what we're doing here. Now, is your age? I've got a question for you. You
Mm-hmm.
told me that you're 27.
Mm-hmm.
You being 27, is that a financial consideration or a non-financial consideration?
My age is a non-financial,
You
I
are
don't
correct, and
think.
that's very testable. That doesn't mean that's not important. It's very important.
It's very important, but that's non-financial. Financial would be more like my balance sheet, my
Yeah,
income
that you got
statement,
something that
and
goes on.
financial
That's
documents.
something that goes on in your balance sheet or income statement. That is exactly the way to get that correct, right? Your
Right.
marital status. Your marital status.
Non-financial.
That's right. Now, if you are married and filing jointly,
Mm-hmm.
what would be the number that would make you as a couple an accredited investor?
Um, 300,000 combined income together. If you were single with no other partner, it'd be 200,000. And then 1 million excluding your primary residence.
Right on, right on. Now, if you are married and you have a joint account,
Right.
you have your own personal account, your husband has his personal account, and you have a joint.
Hmm.
Is that joint account a separate account for purposes of SIPC?
If I had my own joint account or if
Yeah. So is
my
this
joint
two
account
accounts
was,
or three accounts under SIPC? Mr. and Mr. Jones, we'll call you Mrs. Jones, Mr. and Mrs. Jones, joint tenants with rights or survivorship. Is that three accounts or two accounts for purposes of SIPC? What I'm asking
that's two
is
accounts.
that's actually three.
Oh, it's three accounts.
It's three
Okay.
different beneficial ownership there. So that's kind of a trick on
I
terms.
didn't even think of that.
Well, I'm throwing extra stuff in, right?
Yeah, that is very
Right now,
extra. I just think of,
risk tolerance is again a non-financial consideration, but again, very testable.
mhm,
And so again, we're tying now the investment vehicles we've discussed to the potential of losing all your money.
right.
So pretty easy to qualify somebody who wants to buy a call or buy a put or buy
Hmm.
a spread or buy a straddle. Because if you're buying a call, buying a put, buying a spread, debit spread, and then all I got to say is, hey, or buying a straddle is this money you can afford to lose. For everybody, that's a different number, but it is something we should make sure they're comfortable with. I mean, I've had customers who have lost sums of money that would make me go wobbly, but it's certainly do. Everybody's different. I like to gamble, and when I go to the casino and I'm gambling, I sometimes think, man, it's not like our business because they don't even ask these people if it's money they can afford to lose. And they give them adult beverages while they're playing, right?
Hmm.
It'd be hard for you to lose money in government securities or money market securities. All right, so inflation risk. The risk the inflation will outpace your investment returns. How do we measure inflation? How do we measure inflation?
Wouldn't that just be like looking at the duration of
Well, fancy
something?
duration is a fancy word for volatility. What I was looking for is the consumer price index.
Oh, well, yeah, the
The
CPI,
risk
but
that
like,
inflation will outpace your investment return. So we hit a high of 9% inflation. And if I have a 5% bond, I actually went in the hole, right? I mean,
right. But
uh,
also the duration has to do with it as well, because if
duration
the
is
longer the
relative. Yeah, that's right.
duration, the more inflation risk
Well,
you
yeah,
have.
I would rather we call that volatility.
Oh, okay.
The duration is a measurement of a bond's volatilities. So longer term bonds with lower coupons have higher or longer duration, more volatility. But
Oh, okay.
I'm not gonna, be correcting you too much on that. But yeah, longer term bonds are more subject to that.
Right.
Debt securities, fixed annuities, these are all the things that have inflationary risk.
Hmm.
Timing risk, the risk of buying instead of buying low and selling high and buying low.
Right.
Frequent or sure. I always think here about the when we went into the pandemic, and a lot of sector rotation funds actually rotated out of what they thought were stocks that wouldn't do well during the pandemic. And then when the pandemic, we thought it was over, they rotated back into those stocks. And whoops, we had another year of the pandemic, so they missed it twice, which is a problem, right? Interest rate risk we talked about, reinvestment risk. All right, love this one. What bonds do we have that do not have reinvestment risk? Reinvestment risk is associated with falling interest rates, and then you have call risk that you're going to have to give up your bonds. And so, what bonds do we have where we have no call risk?
Zero coupon bonds.
Right on, you nailed it. If the zero coupon bonds would be great for somebody who wants to lock in a rate of return. So you say, hey, Dean, right now, the Fed has said they're lowering interest rates. They've done 50 bips. Now they've done 25 bips. And as these rates come down, I'm afraid my bonds are going to get called. How could I lock in a return? I said, well, we could buy some long-term zero coupon bonds, OIDs, and those would be a way of locking in that rate of return. What else besides zeros?
Wouldn't tips as well be a zero coupon bond?
Well, no, tips, remember, do have a coupon that never changes.
Oh yeah, okay. And then they
So
have the phantom
5%.
income.
Well,
Okay.
yeah, there you go. The 5% is based, not going to change, but it's based on the principal that would be adjusted for inflation, right? So what
Right.
else is not callable besides zero coupon bonds?
What else is not callable? I need to like think because I'm pulling completely out
No,
of
well,
thin
well,
air.
that's me. That's me being a jerk. I'm asking you to pull it completely out of the
Trying
air.
to think what else
Give me
is
zero coupon
non-callable.
bonds
The zero coupon
and
bonds are non.
T-note.
Oh, non.
T-notes
Uh,
and T-bonds are non-callable,
yes.
right? So
But
Treasury
T
security.
are T-bills.
Well, T-bills, you're just going to be doing whatever rates. You're not going to be able to lock in a rate of return, but
Right.
you'd be
Okay.
reinvesting at today's rate. It depends on the context there. Again, we need some context depth, but I like it. T-bills,
Yeah,
you
because
have
I just
interest
remember
rate
reading
risk.
something that they're not callable.
Yeah, well, they're
So,
not. They're not,
right.
but they've been, remember what the T-bill is. We say that the two risk and debt denominated securities are interest rate risk and credit risk. And in T-bills, you don't have interest rate risk because whatever interest rates are doing, that's what you're going to get. And you don't have credit risk. So sometimes we refer to the T-bill as the risk-free rate of return. That's what you get for not hazarding your capital, right? And the reason that's important is we use that as a benchmark. I mean, how silly would it be if I came out to you and say, hey, I'm going to try and do under the T-bill rate? So we're all trying to beat the risk-free rate of return. The reason we use T-bills, a lot of people, I mean, you can use whatever rate you want, but a lot of people don't use a T-note or a T-bond as the risk-free rate of return because there you do have interest rate risk, right?
Right.
Interest rates go up. Call risk, we talked about that.
The falling interest rates.
Right.
Yes.
Remember, just again, just the heading is more risk, less risk, right? So more risk, less risk. You don't have reinvestment risk with rising interest rates because the issuers are going to refinance at higher rates, right? Call risk, we talked about that. So
Hmm.
more or less. Market risk, the risk of losing your principal, exchange traded marketable securities. That, remember, is systematic risk, the risks in the system, the tendency of securities prices to move together. We have less risk if you're buying a non-marketable security like a CD that can't be sold. Credit risk, we talked about that. Risk of default, we talked about credit quality. Credit quality.
Hmm.
We have liquidity risk. We've talked about that.
Yep.
And, and we've talked, oh, this is one you brought up earlier. A lot
And
of people are concerned right now because fiscal policy may change. Fiscal
right.
policy test question is controlled by Congress
Hmm.
and the president. And it looks like all of that is going to change. The Republican Party looks like it's going to take control of the presidency and the Senate and the House. And they may make changes in regulations. In fact, right now, a lot of people are referring to these as the Trump trades. The idea here is to try and figure out what's going to change, right? Legislative risk, you can diversify away, right? You can stay away from investments that you think Congress may mess with. I always joke, what Congress giveth, Congress can taketh away, right? Uh, Maybe we call it legislative risk and reward, perhaps. All right. So this second part of the suitability exercise is available on the channel. I'm not sure if it's done with just me and you hit pause and I explain it, or if I've had somebody kind enough like you have been to share the ride with others. I'll check. If not, maybe we'll do it again in this kind of a setting. But I think that's available to you. So thank you very much for allowing other people to take a free ride with you in this hour on talking and discussing about suitability. I'll put this in the suitability playlist and that'll make 5 videos that are available to you in my suitability playlist for the series 7. All right. Remember, inch
Thank you
by
so
inch, your
much.
series 7 is a cinch. Yard by yard is at heart. And maybe we will talk you into joining us and sharing with others again. Thanks. Any comments to test takers out there?
I don't think so.
Okay, everybody. We'll see you for the next time. Bye bye. Okay, we're out.